Perfect. I think we are live. Can we go ahead, right? Perfect. So, good morning, ladies and gentlemen, and thanks a lot for tuning in today on our Sunday series of having us direct connect with our managers at Small Case. And today we have Saurabh Mukherjee from Marcellus and Krishnan, who will be walking us through their approach and their philosophy of investing and the way they have constructed this entire strategy for the benefit of all the investors. So let me introduce today Saurabh and Krishnan before we start the presentation, and post the presentation we will have all the Q&A which we have got from all you investors, and we'll be more than happy to answer most of the questions. So Saurabh is the founder and CEO of Marcellus Investment Managers. Saurabh is known for his best-selling business books on investing, being The Unusual Billionaires, Coffee Can Investing, Diamonds in the Dust, and The Victory Project. Saurabh has studied at London School of Economics, and Saurabh is also known for his conviction in equity markets, where 90% of his personal investment portfolio is into equities. And we all know, and we keep listening to Saurabh very frequently on all the platforms. Along with Saurabh, we have Krishnan, who basically takes care of the Merito portfolio on Small Case, of course, with the philosophy of Marcellus. And Krishnan has completed his MBA from IIM Kozhikode and engineering from NIT Trichy. He's also a CFA charter holder, and he comes with more than a decade of experience. And his investing focus has been on rule-based investing. Prior to Marcellus, Krishnan has worked with Morningstar, where he was involved in creating systematic rule-based equity and multi-asset investment products. So the today structure, as I just mentioned, we will have a detailed presentation on the entire process, entire philosophy, what Marcellus has been following for the benefit of all the investors. And the topic of today's discussion is basically the importance of diversified equity portfolio, and how does it help all of us to achieve our goals and participate in the markets in a much better manner, managing all our risks as well. So over to you, Saurabh.
Thank you very much. Thank you, Rakesh. Thank you, Small Case, for hosting us this morning. It's a privilege for Krishnan and myself to be here so that we can discuss how MeritorQ works, what MeritorQ does. Before we get into the specifics of MeritorQ, I thought I'll lay the background. So, Krishnan, if you just fire up the slides, we'll just start with some background on what have various asset classes done in India over the last 10, 20, 30 years. Kitna paisa bana hai over the last 10, 20, 30 years for various asset classes. Now, thankfully for us, over the last 3 decades or so, the Indian economy has been in great shape. Actually, there's plenty of data to suggest now that over the last 3 decades or so, we've been one of the best performing economies in the world. And the result of that is pretty much any asset class you invested in, if you've been reasonably sensible about your investing, even something as straightforward as gold has compounded at 9% from 1990 to 2022. Stock market has done better than gold, and fixed deposits have also actually provided a stellar 7.5% over the last 20 years or so. So superficially speaking, the basic data suggests that across asset classes, Indians have done very well over the last 3 decades. Now, the picture changes a little bit once you bring inflation into account. And this is one of the things, the basic things to understand about investing. Overall returns, gross returns look good. When you bring inflation into account, the picture changes. And if you go to the next slide, Krishnan, we'll see, Krishnan has shown you in the next slide how dramatically the picture changes, how dramatically the return picture changes once you bring inflation into account, right? You realize that taking inflation into account, real estate, gold, and fixed deposits are actually not big wealth creators. This is Indian data for the last 10, 20, 30 years. This is not a point of view that Krishnan and I are articulating. This is hard data from India over the last 3 decades. Once you take inflation into account, real estate, gold, and fixed deposits se zyada paisa nahi banta. The main asset class which creates wealth for you after taking inflation into account is equities. We have shown you sort of 2 hypothetical portfolios. If you take a typical spray and pray portfolio, hypothetical portfolio 1, top right hand side, typical spray and pray portfolio, which puts 25% in real estate, 25% gold, 25% in equities, Nifty 50, and on the final quarter in term deposits. You can see that the after inflation, the wealth creation is barely 2.5%. Right? Look at the table on the top right, and after inflation, the inflation adjusted returns are very small. On the other hand, if you take the hypothetical portfolio number two, this is a family where 80% of the assets are invested in the stock market in the Nifty 50. You can see radical wealth creation after inflation. That family is making 6-7%. It's one of the basic things to understand about India is if you want to make money in India, the data is very clearly telling you the only way you can create significant wealth for yourself in the long run is through a heavy allocation to Indian equities, right? Now, why does it work so well? Why do equities create so much wealth for you and me in the long run? Let's go a little further in and we'll look at some of the straightforward maths around this. Right? So, if you go to slide 5, we will show you the basic compounding that's at play here. What's happening here is if you invest even in a 10% compounding at the stock, whether you invest in a stock or the Nifty, 10% compounding, 1 lakh invested today. And remember, this we're just investing 1 lakh, letting it be. 1 lakh invested today becomes 2.6 lakh 10 years hence. Look at that first column. 10 years hence, you're at 2.6 lakhs. And 3 decades, 30 years hence, that becomes 17.5 lakhs. That's 1 lakh today, left alone for 30 years gives you 17.5 lakh, right? But the picture changes dramatically for compounding. 10% compounding itself is actually a pretty healthy number. But if you're able to get to 20%, and most of the products that we have built, product that Krishnan has built, have been able to compound at 20% over long periods of time. If the compounding rate goes from 10 to 20, the returns go up non-linearly. So look at the 10th year return. The 10th year return at 20% compounding is 6.2 lakhs, right? So 10% compounding, first column, 10th year return is 2.6 lakhs. But if the compounding rate is 20%, it's 6.2 lakhs. And when you hit the 30-year mark, and the reason I'm emphasizing the 30-year mark is typical span of an Indian career is 30 years or so. At the 30-year mark, the return number is 2.4 crores. So 1 lakh invested when you are 25 years old or when you are 30 years old, 1 lakh invested in a high quality equity portfolio when you're 25 or 30 years old turns into 2.4 crores at retirement, assuming that you retire, say, 30 years later. A lakh becomes 2.4 crores. And this, I think, is transformation. I think this is the main reason, if you ask me, why people like Krishnan and myself have entered Indian equities. We want to make a difference in people's lives, people who are working hard, saving modest sums of money, saving sums of money in a few lakhs, just starting early in their careers, investing when you're 25, 30, 35, letting the investment run for 20, 30 years will make you worth several crores. In fact, I suspect several $1 million by the time you're done. Now, this is stock-specific investing. We're looking at single stock compounding. The maths gets even more interesting and even more powerful when you look at compounding in the context of a portfolio, right? When you look at compounding in the context of a portfolio. So if you look at 2 stocks, assume you have a simple 2-stock portfolio, you put 100 rupees in stock A and you put 100 rupees in stock B. Now assume that you're unlucky, the fund manager you've given money to is incompetent. Stock B goes to 0 overnight. Stock B ghus jata hai, 0 ban jata hai. And the stock A works out. Stock A goes from 100 to 500 over 10 years. Sorry, over 5 years. It goes to 100 from 100 to 500 over 5 years. And good, high quality Indian companies pentupling in 5 years is reasonably common. At the portfolio level, your 200 rupees becomes 500 rupees over 5 years. Even though one stock has been completely wiped out, stock B completely wiped out, 0 here. At the portfolio level, your 200 becomes 500 and you get the 20% magic 20% compounding number. 20% is the aspirational return all of us should be gunning for, because the index in India itself takes you to 13. If you can push yourself to do high quality equity investing and get to 20, I showed you the miraculous impact it has on your wealth compounding. What we are trying to show you on this slide is even with half your portfolio wiped out, completely wiped out, even with half your portfolio completely wiped out, you can get to the 20% compounding figure. And unsurprisingly, experts like Krishnan, experts like colleague Rakshit Ranjan have been able to get to that figure over extended periods of time. So I'll hand over to Christian, take you through how does one get to this sort of compounding and what are the modalities of getting there. Over to you, Christian.
Thanks, Saurabh. Good morning to everyone who has dialed in. Just please note, again, some of the disclaimers before I get started, that all investment securities in market are subject to market risk. Read all the scheme-related documents before investing, and all the figures which I'll discuss, in subsequent slides are for illustration and understanding only, and do not guarantee any future returns. So with that, I think Saurabh, laid the context, beautifully. What I'll do is I'll just touch upon, the behavioral aspect which Meritor Q, which is the product which we have available on Smallcase, which it tries to address. Right. So let's first look at the classic investment advice, which is given to investors for building their wealth, which is to buy low and sell high. While common sense would suggest that this should be the pursuit of every investor who is participating in the market, what we see is generally the opposite happens. And this can be due to different reasons, right? External noise, emotional biases of investors themselves. And one way this manifests itself is this fear of missing out, what we call as FOMO. When everyone around you, your family, friends, colleagues, TV channels, WhatsApp forwards, everyone is talking about a particular stock, right? The next hot stock to invest in. And this can lead investors to rush into buying that stock, even if it is overvalued, because they fear on missing out on the future price increases, right? So the advice is to buy low and sell high, but you incur losses by actually doing the reverse. Right. And believe it or not, this is a problem which is not only true for normal investors, but it's also true for seasoned portfolio managers, right? Because again, all of us are human beings. We are subject to the same emotional biases. Meritor Q, with its rules-based investment approach, and the rules which we use for creating the portfolio, I'll talk about in the subsequent slide, avoids this issue. Right, because you basically stick to these rules, no matter what. And by sticking to these rules, you avoid biases, you cut out noise, and you stick to a disciplined investment approach. Now, if I have to summarize the investment objective of Meritor Q, it can be summarized in one line as buying good companies, good clean companies at reasonable prices, right? Good or quality companies, we can define it in a number of ways, but in this strategy, we have defined its basis, again, companies which have high returns on capital meaning companies which are both efficient and which are also profitable, those with solid balance sheet, with low debt, and clean companies which are deemed clean per our forensic accounting framework, right? Now I'll come to again these screens in more detail, but this is how we are defining good clean companies. And when we buy these good clean companies, we ideally want to buy them at prices below their intrinsic value. Intrinsic value again can be defined number of ways, but in Meritor Q, we are looking at relative value based on price to free cash flow. So just to maybe give an example on what we mean by this, let's take two companies, company A and company B. If you assume that both of them, just for sake of this example, have a market cap of say 100 rupees, right? And company A has a free cash flow of 20 rupees. Company B has a free cash flow of 80 rupees. We prefer company B over company A in Meritor Q. And free cash flow, again, it's defined in the same way we define, again, it's usually calculated. So it's basically your cash flows after all the working capital investments, as well as all the capital investments that are required for running the business for any company. So, good undervalued companies picked regularly while avoiding biases and cutting out noise. And we do this repeatedly. In subsequent slides, we will see how we have tried to address each of these principles as part of the portfolio construction process. So, one way to think about, these rules which we talk about in Meritor Q, when we say it's a rules-based product, essentially it's the rules which go into the portfolio creation. You can think about these rules as a simple checklist. In fact, you can think about Meritor Q as nothing but a simple checklist of good investment rules which reduce your chance of making bad investment decisions. I'm sure all of you would have used checklists at some point in your life. For example, a list of 2 to-do things, or maybe a list for buying groceries, right? And why do we need checklist or all this list? Because we have limited memories. We're all human beings, and we tend to forget, right? And even if we remember, we don't remember consistently, right? And this is where checklists become really useful, right? In fact, checklists have been found useful in other domains like aviation and surgery as well. For example, checklists are widely used by pilots for flying airplanes, in the big civilian airplanes like B747 or A320, and they have been found very effective in reducing mistakes, and also ensuring that pilots, no matter how experienced they are, they perform all the steps for flying the airplanes precisely and without missing any step unfailingly. So just as with grocery checklists or checklist in aviation and investment checklists, make sure that we're applying all these checks consistently and without exception. Now let's look at the steps which we follow in this Meritor-Q checklist, as we are saying, right? So the very first step in Meritor-Q, in this Meritor-Q checklist, is we start with this, our investment universe, which is the large, mid, and small cap stocks in India, the top 500 companies in India, listed companies in India, which is equivalent to a BSE 500 or a Nifty 500 universe. From here, we remove companies, around 200 companies, basis our forensic screen. Again, I don't think I need to speak a lot more on this, but again, just to maybe quickly touch upon this, we have highlighted this, in our newsletters and, even some of our books like Diamonds in the Dust, where we have shown that companies with governance issues and those with accounting irregularities in, a broad-based index like BSE 500, investing in those can, again, companies with this kind of issues can lead to permanent loss of capital, right? And good investing is as much about avoiding wealth destroying companies, these kind of fraud companies or wealth destroying companies, as much as it is about picking winners. So we remove earnings manipulators and such fraud companies in this forensic screening step, right? So we roughly remove around 200 companies, like I said. Now with the remaining 300 odd companies, right, we look at companies which borrow too much, they take too much loans from the bank. So I'm sure you would be aware that, again, most of the people who are listening to this call would be aware that, leverage is a double-edged sword, and too much debt is never good for any company, or, even for individuals, or whether it's a company level, too much debt is never a good thing, right? And the focus on Meritor-Q is to generate consistent returns. So we remove highly leveraged companies in this step. Right, consistent profitability step again ensures that that we do not invest in companies which are extremely cyclical, and those which do not have a consistent a track record of generating consistent profitability. This is because it is extremely hard even if you invest in these companies to form any reliable view on where the fundamentals of such companies might end up, even during a 1 year holding period. So even if you, for example, just taking an example, if you invest in an oil and gas company, most of the cash flows or even the earnings of such companies are driven by oil and gas prices, and mostly these are commodities whose prices are determined by the global supply demand, over which the company itself doesn't have any control. So we tend to avoid such companies in Meritor-Q. So these three steps, the forensic screening step, the high, removing companies with high debt, and those with inconsistent profitability or cyclical companies, all these three steps can be thought of as screening steps or filtering steps, right? Because essentially we are removing companies through these steps. After these applying these three steps, we are left with around 80 to 90 companies on which we select again cheap as well as quality companies, while avoiding value traps as well as overpaying for quality, right? And the final step in Meritor-Q is we assign higher allocation to those companies which are undervalued, relatively more undervalued, basis price to free cash flow, as I discussed in the previous slide. So this, these are the 5 steps again in the Meritor-Q investment checklist. We go through this checklist essentially for portfolio creation twice in a year, on the first trading date of April and October, which we call as rebalancing. So this is the checklist, and these are the investment rules, the 5 investment rules which we follow in Meritor-Q. Now let's try to understand what rebalancing is, and what is the purpose of rebalancing in Meritor-Q. So like I said, going through the checklist twice in a year the 5 steps in the checklist twice in a year and refreshing the portfolio per the checklist is what is rebalancing, right? So rebalancing allows you to basically achieve 2 things, right? One, it allows you to pick up undervalued stock regularly. So every once in 6 months, we get rid of stocks or reduce allocation to those stocks whose prices have run up in relation to their free cash flows or with respect to their fundamentals. In their place, we pick the next set of undervalued companies, again basis, which are undervalued basis price to free cash flow. Each stock selected in the portfolio is held for at least a year to give enough time for the prices of these undervalued companies to appreciate and converge to their free cash flow. Secondly, rebalancing allows you to also reflect any change in the fundamentals of these companies, right? So imagine a company which was, which is in your portfolio, which was passing the forensic screening, or forensic screening step or a forensic screening check 1 year back, but it's no longer doing so now, basis the updated financial disclosures by the company, right? So again, what rebalancing allows you to do is it allows you to get rid of such a company from the portfolio, right? So essentially reflecting the updated fundamentals of the company. Obviously, this change in fundamentals, reflecting the change in fundamentals is more applicable to the September rebalancing because that is when we would have the updated financial information of all the BSE 500 companies, which is for all the BSE 500 companies is available. In the April rebalancing, it is more about the valuation, which is reflected in the final portfolio construct. So rebalancing obviously causes churn, and we have found that again the average turnover, the average one-way turnover, the churn rate roughly comes at around 50% when you follow these steps in the Meritor-Q checklist and you do this rebalancing twice in a year. So roughly 50% average turnover is what you should expect or investors can expect going forward in Meritor-Q. So maybe given what we are discussing today, let's maybe touch a bit on how does Meritor-Q achieve this diversification, right? So again, how we have thought about diversification in Meritor-Q. So because again, you can think of, again, like I said, Meritor-Q is a rules-based strategy. It's we follow a set of rules, and because of the data-driven, repeatable process, followed by again these rules-based strategy, it is generally more efficient for them to increase the breadth or the number of investment opportunities, right? So a larger breadth, which you can think of, in a way loosely translated to a larger portfolio size, i.e., picking more stocks or rebalancing more often and considering more factors, right? Essentially, we are looking at value and quality in Meritor-Q. Considering more factors in your portfolio construction process is an advantage rather than a handicap, right? And this is only true, however, as long as the returns can survive all the transaction costs. Because obviously, as you rebalance more often, it's very straightforward to think that you would incur more transaction costs. So whatever you're doing, in terms of increasing your breadth, right, investment breadth, it should survive the transaction cost from the higher turnover, right? In fact, when you there is a well-known relationship which kind of relates the relative risk-adjusted return of a strategy. It's called the fundamental law of active management to the to the square root of the breadth and the skill of a manager, right? So this holds true for all strategies, right? All actively managed strategies, this holds true for. So a simple way of thinking about this is, if you increase the breadth, right? So if your number of independent bets in a year goes up by 4 times, say by rebalancing 2 times and doubling your portfolio size, right? So your excess risk-adjusted return roughly goes up by twice, right? It doubles because you're rebalancing twice more often, and your portfolio size is also doubled, right? So it's because it's square root of breadth, so your excess risk-adjusted return or relative risk-adjusted return goes up by 2 times, right? It doubles, right? So, but again, this is a this is an approximate relationship. There are obviously real world constraints like transaction costs, again, like I said, right? And also this assumes that this breadth or, this independent bets which you're taking or the independent decisions you're taking, they're all truly independent, right? Which is generally not the case, right? So, again, even with all these constraints, I just wanted to kind of lay this out in terms of why a bigger breadth or a larger breadth is generally more suitable for rules-based strategies as such, right? So the key takeaway here is even with a small edge, right? So when you say a small edge, essentially you're talking about the skill or the hit rate, right? So the skill in this, the equation which you see at the bottom in this slide. Even with a small skill, even with a hit rate of around 51 to 52%, suppose, right? You have a very small edge, suppose, right? And this you can think of the skill or this hit rate as a probability of identifying outperforming stock, right? Even with the small skill, diversification by picking up more stocks, right? I.e. a larger portfolio, or picking up stocks more often, right? I.e. rebalancing more often, or kind of also targeting more factors. As in Merit.Q, we are looking at value and quality, and both these factors, by the way, are also they have a low correlation, right? So in a way, they also have that, they satisfy that criteria of independent portfolio decisions we are taking, right? All this can increase the portfolio breadth, which in turn can boost your excess risk adjusted return. So yeah, I mean, so this is how again, this diversification kind of helps in a way to enhance the risk adjusted return, and this is especially well suited for rules-based strategies like Merit.Q. Now, again, the question obviously would be, why don't we then rebalance every day, or why don't we select nearly all the stocks, right? Maximum number of stocks possible. So there are a couple of constraints, right? And this is the reason why we select less than 50 stocks in Merit.Q, which we talk about in this slide. Firstly, the investment universe of Merit.Q is restricted to top 500 stocks, right? And the simple reason here is in India, the trading liquidity, kind of drops rapidly after the, in fact, it drops rapidly even beyond the largest 200, 250 names, right? So again, liquidity is a concern. Second is the screening steps, whether it's forensic screening, consistent profit, high debt, removing high debt companies. They are essential to avoid investing in well destroyers, right? So essentially, you can think of these screening steps as identifying those companies, right, which have the best odds of future outperformance, right? So what the screening steps are allowing you to do is they are kind of maximizing your odds, the skill which we talked about in the previous slide, right? And the breadth then comes into play, whether in terms of rebalancing or in terms of when we are doing the selection, when we are selecting both profitable as well as undervalued companies, right? Now the second question being, why don't we again select lot of stocks? The simple reason is if you rebalance more often, the downside is higher portfolio churn, higher transaction costs, which is never a good thing. What we have found basis our research is, when you rebalance twice in a year, it gives you the best balance between the transaction cost and the risk adjusted return, right? And that's why we have gone ahead with this. We have this semi-annual rebalancing in Merit.Q. Also, if you're selecting more than 40 stocks, right? So if you can go beyond, you can select the entire screened universe, right? So essentially the 80, 90 companies that you get after applying all the screening steps. But why don't we do that? Simple reason is, the dilution in terms of the portfolio quality, right? Because we want to select, remember, companies which are both undervalued and which are profitable, right? Now, going beyond the 40, selecting more than 40 companies would mean your profitability and valuation is inferior compared to an average stock, right? So you're not even better than the average stock in the post-screen universe. So it kind of dilutes the efficacy of the selection step. So that's the reason we have restricted our the portfolio size in Merit.Q to 30 to 40 companies, right? So what this bar chart here on this slide shows is, this emphasizes this point further. Here we have shown the 3-year rolling return on Merit.Q strategies for different portfolio sizes, from the smallest 13 to 18 stocks on the left, to the full screen universe, basically the 80, 90 company which I was talking about after applying those 3 screening steps. And all the strategies, what you see here, they're all equal weighted, semi-annually rebalanced, and they follow the screening and the selection steps, which we have highlighted in Meritor Q, right? And you can clearly see that the 30 to 40 stocks, which has a 40% selection ratio. When I say selection ratio, essentially 30-40 as a ratio of your 80 to 90 companies in your post-screen universe. So those 30 to 40 stocks generates the highest return, comparable to 19 to 25 stocks, but it has, apart from these two, others have inferior, 3-year rolling returns, right? So the Meritor Q checklist of investment rules filters the investment universe to the set of stocks with the best odds of future outperformance. And the portfolio size, the 30 to 45 stocks, which we have in the final portfolio, and the semi-annual rebalancing frequencies. The semi-annual rebalancing frequency allows investors to benefit from the breadth of investment opportunities while keeping the portfolio churn under control, right? So now, again, this chart again, we are showing the 3-year risk-adjusted return, not just the returns, but the risk-adjusted return, basically returns per unit of risk. This is, the red line chart which you see on this graph, and the turnover, which is the blue line. Again, this is we have shown this for different portfolio sizes from 13 to 18 stocks to the biggest portfolio, which is your entire screen universe, right? So your left side of this chart, as you go from left to right, your portfolio becomes more and more bigger, right? So the larger portfolio, more diversified portfolio. But what you can see again here is the 30 to 40 stocks, right, which we which is the portfolio size in Meritor Q, that maximizes the risk-adjusted performance for the strategy, right? The turnover, you can see that it's the highest for the most concentrated portfolio, and it goes down again almost linearly to to when you consider the full post-screen universe. And the simple reason here is the screening steps don't introduce a lot of turnover, right? The screening steps, the turnover due to them is roughly around 30 odd percent, 25 to 30%. So the turnover, basically half of the turnover, in fact, comes from the selection step where you're considering valuation, right? Which here, there again, we are considering prices, which again tends to move around more frequently, right? So so as you move from the concentrated to bigger portfolio, your turnover decreases. But you can see that the risk-adjusted, when you just look at the risk-adjusted numbers, the 30 to 40 stocks in this particular portfolio constructed maximizes your risk-adjusted return. And your churn is also, like I said, it's around 50%, annualized, which is again the the semi-annual rebalancing, which we consider in Meritor Q. Now, if your question is again, if this large portfolio size, how does it help you in managing drawdown risk? Yes, it does, right? So especially if you compare drawdowns in two scenarios in global financial crisis and COVID, during COVID, the COVID drawdown period, you can see that Meritor Q, the 30 to 40 portfolio size in Meritor Q has had a lower drawdown, 5 to 7 percentage point lower drawdown compared to more concentrated versions, 19 to 25 and 13 to 18 stocks, at least in the GFC period or the GFC drawdown, maybe not so much during the Corona crisis, right? And again, this is to be expected, right? Because what happens is, as you increase your portfolio size, your allocation to single stock reduces. And so, so what we have seen in Meritor Q, for example, is your allocation towards a single stock doesn't exceed more than 12%. At any time, at rebalance over the last 16 years when we have backtested the performance, and not more than 22% in the top 5 positions, right? So obviously that kind of acts as a kind of a check on the your allocation, your concentration in terms of allocations, as well as on this the drawdown risk. So just to maybe summarize, all these steps, which we have talked about in Meritor Q have been backtested over the last 16 years, from July 2006 to September 2022. And this slide shows you the impact of each of the rules, right, in the strategy, the 5 steps in the checklist, which we talked about, and how they contribute in terms of the overall performance. So the final chart which you see on your left essentially breaks this down in terms of the individual checks, the individual 5 steps in the Meritor queue or investment checklist, right? So starting from the top, your first step, which is your overall universe, you can see that has a rolling return of around 8%, right? Again, this, we are showing this return from July 2006 to September 2022, 8% 3-year rolling return for the top 500 stocks, which is your large, middle, small cap companies, right? After the forensic screen, after you apply the forensic screen, your 3-year rolling returns goes up by around 5%, 4.9% to be exact. And each of the subsequent steps, right, the consistent profitability, the leverage step, and the selection step, you can see that it's adding to the overall, the returns of the strategy, and it goes from around 8% for the, the universe, the equal weighted universe, to roughly around 22% for the final portfolio after the position sizing, right? And like I said, this is a 30 to 45 stock portfolio. The right chart shows you the actual wealth curve, right? So if you had invested 10,000 in July 2006 in Meritor Q and in Nifty 500, how your wealth would have compounded. Roughly your wealth would have compounded by almost 20 times in case of Meritor Q, and around 7 times for the benchmark. And this 20 times for Meritor Q roughly translates around roughly 20% annualized return over the 16-year period we have considered for this back test, right? And please note again, all the numbers we are showing here is the returns are gross of any transaction cost or taxes or expenses, any fees, etc. And also all these returns are shown in price return terms, i.e. they do not include any reinvestment of dividends, right? No returns are assumed from the dividends. So again, just to maybe touch upon, the message we started out with, this is a rules-based strategy, which allows you to, again, reduce your biases, cut out noise. And it's, we have, it's a very transparent strategy, right? You can, see the investment rules right in front of you, or, the rules we are applying and why we applied these rules to create the portfolio. Like Saurabh said earlier, right? This is this is an equity product, so you need to have at least a 3-year investment horizon, right? And this is the recommended, at least a 3-year investment horizon is recommended for this product, because again, you need to obviously stay invested and ride out the volatility to get the full benefit of compounding of returns. So that's all from me. Rakesh, over to you.
Yeah, thanks, Krishnan, for that detailed presentation. I'm audible, right, Krishnan?
Yes.
Yeah, perfect. So we have received a couple of questions on our YouTube channel as well. So maybe what I'll do, I'll just pick up some of the questions which are pertaining to the presentation already you have shared right now. So maybe some of them are already covered. It's just that if you can just put spotlight on those pointers again. So somebody has asked, and I think this is the crux of this entire presentation, that why one should buy the complete portfolio and not tweak it basis of individual stocks understanding. Because a lot of times, and again, this is based on our experience, Krishnan, a lot of times the manager, the fund manager or the small case manager, they comes up with the portfolio, but the client always have their own biases, own understanding to certain extent of a particular stock, and they end up tweaking the particular stock, either buying it or changing the quantity, because again, as an advisor, we can do only that much. So what would be your take and advice to one, and how one should approach this whole thing?
Yeah, so I'll just go back to the slide which Saurabh talked about, right? I think which explained this this concept of why portfolio is better than investing in single stocks, right? This is slide 5, and here you can see again very simplistic example which Saurabh took, right? So you just taking 2 stocks, right? And here we are just putting 100 rupees each in both those stocks, right? And here we are saying that one of the stocks the price goes down to 0, so essentially the company has gone bankrupt, right? So essentially, if you think about it, you essentially have a 50% hit rate, right? So half of the time you're wrong and half of the time you're right. right? But that's the beauty of portfolio diversification, right? So even if half of the time you're right, in this case, stock A, assuming it goes again in this case from 100 to 500, which is not, again, too much of an ask, right, over a 5-year period, still you have compounded your returns, portfolio returns by 20%, right? Now, if, for example, if you take the other extreme, and if if someone had just invested in stock B, right, again, very unfortunate, but you just somehow ended up with stock B in your portfolio. That investor, the returns would be minus 100%, right?
Okay.
So again, that tells you again the benefit of having a diversified portfolio, right? And like I said, again, diversification, can be achieved in a number of ways. It need not be just be the portfolio size, right? It could be, again, you could have, all the stocks, maybe 100 stocks in the portfolio, they have the same, they're exposed to the same risk, right? So again, having exposure to stocks in your portfolio, again, which have different types of risk, so that even if some of the stocks don't do well, you're still your portfolio does well overall. And assuming your position sized correctly, again, these your overall portfolio returns should just be fine, right? And in context of, again, your second part of your question, maybe why should you not make tweaks to the the portfolio which we are advising? The simple reason is, look, we have thought about this portfolio and this entire portfolio construct all together, right? Like like you have explained, nearly all our research has gone at the portfolio level, right? We are all our returns we are showing you, these are all at a portfolio level, right? Or this makes sense only if the investors are buying or subscribing to the full portfolio. Now, if you pick and choose individual stocks, right, it could happen that you might miss out on the diversification, right? Or again, you might unintentionally take up very concentrated allocations to certain stocks, because as you get rid of certain stocks, what will generally happen is the weights of allocation to those stocks will get redistributed to the rest of the portfolio, right? So you'll unintentionally increase your allocation to certain stocks, or you might be overweight certain stocks much more than what we intended, and then the result would not be, again, either in terms of drawdowns, etc., you'll be exposed to those risks.
Sure. So just taking a step back, and maybe this is to you, Saurabh. So we just, I think, before the presentation started, in a couple of slides, you touched upon how different asset classes has performed, including gold, debt, real estate, and all that. So just taking a step back, right now we are talking about diversification within the equity asset class as a whole, right? So do you see any merit? And of course, there are a lot of theories on that front as well, that maybe one of the asset class, say gold, has always anchored the returns whenever the times are tough for equity markets. So as an investor, does it make sense to have diversification to that extent, even at asset class? Of course, within equity, we all understand the diversification part, which we just discussed. But what would be your take on the diversification on assets? Because as we all know, every investor is different. In your case, you already mentioned publicly that it's 90% equities, but I'm sure you will have a perspective to that as well, for especially somebody who has asked this question, who is in the age bracket of, say, 40 to 45.
So, Rakesh, the challenge is gold does not give diversification. So it's a myth. It's a myth peddled by vested interests that gold gives diversification. The data from the World Gold Council is easy to get. And if you looked at the data from the World Gold Council on gold prices in rupee terms, and you look at the Nifty, you'll see gold and the Indian stock market is positively correlated. So therefore, the diversification argument is a myth rather than a fact. Secondly, as we showed in that first slide, which I presented, gold's long-term returns are substantially below the Nifty. Substantially, 4% below the Nifty, and gold long-term returns are not significantly in excess of inflation in India, whereas the stock market in India gives significantly higher returns than inflation. And thirdly, volatility for gold is the same as the volatility for the Nifty 50. So if at least gold was less volatile than equities, there could be a case for it. If gold's returns were higher than equities, there could be a case for it. If gold was had a negative correlation or zero correlation with equities, there could be a case for it. Unfortunately, none of that holds true, and therefore I don't see any logical reason why anybody should have gold in an Indian wealth portfolio.
Sure, great. So that is helpful. On another count, like, so basically, Marcellus has always championed the investing approach where the company should have clear accounts, they should have clear promoters, and of course, a big moat. But then on the other front, when you have all of them together, okay, most of them are fairly large companies or they are leaders in their own right, because that is again part of the research and the screener that every business what Marcellus gets into has to have this kind of attributes. Now, if there are so many open attributes which are there out, and I'm sure the market will identify this as well, and there will be already a large P assigned to that particular stock or a company. So what are we playing out here? Are we playing on the PE expansion for this kind of companies, or how Marcellus looks at it, or it's only the EPS growth which will help the investor create wealth?
So just to be clear, in Meritor Q, every 6 months when Krishnan is rebalancing the portfolio, he's rebalancing not just on the basis of fundamentals improving over the preceding 6 months. So, for example, if between 1st April 2023 and 1st September 2023, a company that's in the portfolio return on capital has sharply gone down, leverage has gone up, then in Krishnan is rebalancing, it's highly likely that that company will either be eliminated or have a sharply reduced position. And similarly, if between 1st April 2023 and 1st September 23, if a company which wasn't in the portfolio demonstrates sharp improvements in profitability and or sharp reductions in debt, the chances increase of it making a Meritor Q. In addition, though, Krishnan is also rebalancing on valuation. So just focusing on the previous company whose fundamentals improved between 1st April and 1st September. If in those 6 months valuations tripled, then the chances of Krishnan reallocating upwards to that company diminish, and focusing on that second company whose fundamentals deteriorated between 1st April and 1st September. If the valuations dropped sharply, Krishnan's portfolio might be inclined to take it up. So the Meritor Q quant process takes both fundamentals, classical Marcellus style fundamentals, good accounts, low debt equity, high levels of profitability, and alongside that, Krishnan's combining that with valuation screening every 6 months, and I think that's the right way to run quant. In quant, remember, you're not doing detailed months of work like our qualitative teams do on stock. In quant, you are using the sort of model, the quant model Krishnan laid out. And in quant, therefore, it both makes sense to have more stocks in the portfolio. Krishnan's laid out why Meritor Q is a 30 to 50 stock portfolio. It makes sense to have more stocks in the portfolio. It makes sense to screen for valuations using a valuation screen. And it also makes sense to check for changes in fundamentals every 6 months rather than letting the portfolio run for several years with very little interference, as our qualitative fund managers do. So quant and qualitative investing are very different. Krishnan is a master in quant investing, and the process he's created, the process that he's laid out for Meritor Q, is simple, it's effective, it's worked beautifully. It's worked beautifully for our 600 or so clients who've joined us in Meritor Q over the last year or so. I myself am a Meritor Q customer, and I hope that other people who are watching the webinar appreciate the simplicity and the power of this. You're screening away naughty companies, you're screening away high debt companies, you're screening in highly profitable companies, and you're screening in highly profitable companies, trading at attractive valuations, and you redo the screen every 6 months. Simple, effective way to compound wealth in the Indian market. Just for clarity, this portfolio is heavier on small and mid caps. This portfolio is heavier on small and mid caps than our PMS portfolios. Krishnan, do you want to just lay out the relative weights of small and mid caps in Meritor Q versus large caps? Right? How much of the portfolio will be SMIDs?
Yeah, so the current portfolio, roughly 75% of the allocation is in small and mid caps, and roughly around 25% is in large caps.
Perfect. I think, Krishnan, you can just stop this presentation sharing. I think there are a lot of fans of Saurabh as well, and they just want to hear him like as in one. Saurabh, if you can just adjust a camera bit. I think one of the users just mentioned that he was not able to see you. In fact, even I missed that. But yeah, I think this is helpful because people really love to see you and hear you a lot. So that was the feedback. Okay, so one more question coming up, and maybe this is to you, Krishnan, very specific to Meritocube portfolio. And of course, you can always comment on this. Historically, what has been the average churn during each rebalancing? Because as I understand, there is only one rebalancing every 6 months. And whatever journey we have covered so far on Meritocube, it has been, I think, over 2.5 years, to my knowledge. So what has been the average percentage churn during each rebalancing? And what has been your experience or learning in that process?
Yeah, so in the April rebalancing, the churn was, this time the churn was higher. So we launched this portfolio in October. And in April, it was slightly higher because we made a few tweaks to the portfolio, the methodology. Again, very small tweaks, but they did contribute a bit to the churn. Again, roughly the churn came to around, if I'm not wrong, some 35%, right? And I'm talking about one-way turnover, right? Or this the churn I'm talking about is not just stocks, being sold. It's also the change in the weightages, the weight or change in the allocations, right? So it's the overall number. So it's around 35%, right? In the the October rebalancing, which we just did, 2 weeks back, the churn was somewhere around 33, right? So again, if you just add up these two numbers and compare that to 50%, which we are telling you, the churn is slightly higher than the 50% run rate because of the change in the methodology, some of the tweaks we have made, which is somewhat of an ongoing process. But going forward, we do expect the turnover of the churn to normalize to the 50% or roughly around the 50-55% mark, which we have talked about today. In terms of learning, again, look, we the one tough thing is, again, we still find stocks, right, after we apply all these steps, few unsavory stocks, again, they have governance issues, right? So there are for example, companies which still get through our forensic screening steps, which still have governance issue, right? In which we, as again, as a company or as Marcellus, we are not comfortable investing in, right? So in the live portfolio, we have a step in the end where we manually remove these stocks, but the challenge still remains that, again, our forensic screening or these steps are still not perfect, right? So we obviously try to refine it as much as possible, but still there are a few stocks, if you can think about it, some of these are, again, very difficult to quantify also, right? Because there could be promoter level issues, which is very difficult to quantify, very difficult to figure out whether there's been there's something going on just from the financial statements of the company, right? So so that's been a learning. So in terms of again, our forensic screening still lets through companies in the final portfolio which we might not want in the final portfolio which we offer to clients, which we have to manually remove, right? So we ideally want to minimize it. We want our quant screening steps to kind of remove all these companies as much as possible, so that our manual intervention is minimized as much as possible. So that's where, again, we would try to do this better going forward, where we would try to focus our research also going forward. But that's been one of the learn, right? So despite having put all the effort in building these steps, we still find a few companies which which are uninvestable for us when we look at in the final.
Rakesh, can you hear us? Rakesh, can you hear us?
You're on mute, Rakesh.
Oh, sorry, my bad. Really sorry for that. So just on the rebalancing bit, one of the user is asking, so most of the reasons, or basically all the reasons, will be more on the quant part of it, taking care of the reasons which are specific to that company and not necessarily on the prices of the stock, right? So for example, if everything is going good based on the parameters, whatever you had selected based on which parameters, and they are still intact, we will continue with that stock, right? So it doesn't matter whether the prices have increased or so even valuation is part of that one of the parameter at quant, right? So yes. if the stock is good, but the valuation is hitting the roof, you can always take that into consideration for rebalancing.
Yes, of course.
Perfect.
So we not only consider valuation, in fact, in the selection, but it is also in the position sizing, like I said, right? So if the stock, for example, the prices have appreciated, right, meaningfully over, say, the last 6 months, you would either find the position sizing is trimmed or the stock, is removed, because either, it's no longer as undervalued as it was, or you have better or more undervalued stocks, which are available compared to that stock, right?
Sure. So maybe in the interest of the time, I'll just take 1 or 2 questions more. So of days, like we have been hearing a lot of, I think, information and content on this debate, right? And it has been there for a while, but I think of days it is picking up a lot about active versus passive, right? And the moment one hears about passive, it's all about diversification. So I think that diversification point is well taken. Now, the next question comes that what is the difference between index or passive fund versus a strategy like Meritocrew? The reason why I'm asking this, and this is just a one-line question, but I'm just giving some more context to this, is because now we come across a lot of indexes and passives which are actually created around some strategies and all that, and they end up running like an index technically. So how you will position Meritocrew versus an index or a passive fund?
Okay, I can take that. Maybe answer, the first, and maybe Saurabh can add on top of it. So if you think about a, true passive strategy, Rakesh, so, strategy is only passive only if it is, the allocation or the weightage is decided by the free float market cap, right? And again, if you follow any other allocation scheme, right, it becomes an active strategy because you're taking an active call. Right. So because you have if you think about it, it's only the market cap weighting in which you don't have to rebalance every day because you automatically rebalance, right? And that's why it is passive, right? So you don't have to do any intervention in your portfolio at any given day. The allocation you have is basically in terms of the market cap weighting, right? So because the investors don't need to change their allocations repeatedly, it is a passive strategy. You don't have to do anything, right? But the downside of this is, and even though passive strategies are generally thought about as offering diversification, the downside of this is actually it's the other way around. They don't offer a lot of diversification, right? Simply because you have done your allocation basis market cap, right? So in a way, you're saying that a company which is already the biggest, right? You have the highest weightage to that company, right? So even though such a scheme allows you to minimize your transaction cost, you don't have to rebalance often. That is, there's no diversification here. So it could be if you're for example holding the Nifty 50. You might think that you're holding 50 stocks in your portfolio, but actually, if you look at your allocations, the top I think the 10 stocks would be the allocation would be north of say 40%, right? I don't have the I don't recall the latest numbers, but it would be definitely more than 40%, right? 35 to 40%. So the point being that passive strategies don't offer diversification, right? And also again, you might have a lot of allocation to large companies, right? And we all know that small companies generally, as long as you're picking undervalued, good quality small companies, smaller mid caps, the return potential generally tends to be higher, right, compared to large caps, right? So again, that's the point that if you're looking at diversification and maybe passive strategies don't offer the true diversification, and maybe they minimize your transaction cost. But definitely not comparable to active strategies, when you think about diversification.
Sure.
So I can just contribute.
Yeah,
Given my
please.
2 cents here. Yeah, active versus passive, this is the wrong debate to focus on. Why is it the wrong debate to focus on? There are more indices in the world than there are now stocks. There are more indices in the world, there are now stocks. So you could say, somebody could say, I'm a passive bhakt boss. I'm a passive bhakt. I've read somewhere that passive mein kharcha kam hota hai, paisa zyada banta hai. And you could do passive, but you will buy and sell so many indices in your life that you'll have the same challenges as stock-specific investing. I stress again, there are more indices and ETFs in the world now than there are stocks. And therefore, the real debate, I think, is between rule-based investing and random investing, right? Rule-based investing says, Rakesh, Krishnan, Saurabh, whoever is watching this today, that person says, I have a philosophy for investing. मेरे कुछ rule है, मेरे कुछ नियम है, मेरे कुछ सिद्धांत हैं, उनके basis पे मैं invest करता हूँ. That's called rule-based investing. Random investing is आज सुबह उठ के जो मन किया, whatever I felt like, मैंने कुछ सट्टा सुट्टा मार दिया. कभी large cap index ले लिया, small cap ले लिया, कभी quant लिया, कभी metals mining का index ले लिया. And you can see what I'm getting at, right? If you want to make money in investing, you have to have rule-based investing. You can either try to create your own rules, think about investing, read about investing, watch small case webinars, come up with your own rules, or you adopt rules created by experts like Krishnan, ourselves at Marcellus. We have written books on it. My learning in life is you have to do rule-based investing. You have to have certain principles which tell you how to go about investing. What Krishnan has done in MeritorQ is give you a simple rule-based investing portfolio, which works on some quantitative rules. He's made the rules transparent to you. Every 6 months, he's rebalancing the portfolio based on the rules. Either come up with your own rules and implement them, or you can use Krishnan's rules. But the active versus passive debate is the wrong debate. The right debate is rule-based principled investing on the one side and random investing on the other side. Random investing doesn't make money.
Great. I think this was super insightful, Saurabh. And maybe as a closing note, I think what everybody wants to hear is, though we always keep on saying there's no timing and all that, but the idea here is to gain some kind of confidence, some kind of insights on the current market environment as well. And the outlook, not necessarily market outlook. When I say it's more about the environment outlook in which we are operating. That would be really nice to hear as a closing.
Look, I think I'll keep this simple. I have never seen an economy anywhere in the world where interest rates have gone up 2.5% and the economy is in this shape, right? So just step back and think about what's happening in our country. GDP growth is somewhere around the 7% mark, I reckon. I think the 1Q data of 8%, I think is a little over the top. More likely, I think GDP growth is around 7%. Good quality companies in our portfolios are compounding earnings at around the 20% mark. Corporate balance sheets in India are the healthiest they've been in 20 years. And all of this at the top of the rate cycle. Last 1.5 साल में India में rates have risen 2.5%, United States में 6.5%. At the top of the rate cycle, India's economy is growing at 7%. That bodes well, I think, in the years ahead. Interest rates are more likely than not to come down. As interest rates come down, we will see economic growth improve a notch further. In parallel, China's blow up is epic. China has 7 times more foreign investor money in its stock market than India. China's 10-year return is 4%. India's 10-year return in dollar terms, like for like, China 4%, India 13%. The Indian economy, the Indian stock market has delivered 3 to 4 times the returns of the Chinese stock market. Therefore, it is inevitable we will see foreign investor money turn towards India. Foreigners have 3.5 trillion invested in China. Even if they swing 0.5 trillion of that towards India over the next 5 years, you and I will be in a good place from a stock market flows perspective. The combination of strong economy, strong corporate balance sheets, all of that at the top of the interest rate cycle, combined with taking China into a economic hellhole of epic proportions, I think the outlook for high quality investing in India is the brightest it's been for the last 2 or 3 decades.
Perfect. I think it couldn't have been better than this, Saurabh. So thanks a lot, everybody. And if any of you resonate with this entire philosophy of Marcellus way of investing, feel free to explore their small cases on our platform. So you can always visit marcellus.smallcase.com, or you can always visit smallcase.com and you can look up to the Marcellus small case, and feel free to message us or email us if you have any questions. We will be more than happy to answer all of them. I think with this, time to wrap up, Saurabh, Krishnan, thanks a lot for this opportunity.
Thank you for hosting us.
Yeah, really looking forward for having more such insightful webinars. Maybe sometime next, we might have a more of a masterclass format on investing philosophy, which you just said, right? Rule-based. So maybe we can just navigate that journey as well separately some other day. Thanks a lot, Krishna.
Thank you.
Thank you, Saurabh.
Thank you.
Have a great day.
Thank you, guys. Thank you.